Okay, this is great. We're back. Another law firm legal webinar from the Feller Group PC. My name is Alan Feller, and very happy that you're all here with me on tax deadline day. A very exciting day. It's beautiful weather out here in New York. So I hope that after you've done your taxes, taking a little walk around the neighborhood, got a cup of coffee, you're here with me to spend some time talking about planning, talking about all the fun stuff you do after you've already gotten your taxes ready, brought all your paperwork together, organized things, and are actually coming to some stark realizations about your financial future, your estate planning future, family dynamics. This is the fun stuff. This is when we look at the macro after looking at the micro with your tax returns. But I want to welcome everybody that's joining. I see a nice number of people are here with me today. And we'll talk, we'll go over things. We have question answer at the end of this. So if something is flying by and whizzing by your brain, you have time to talk to me and go over back and forth. So we'll have some fun. We'll dive in. And today's topic is we call it after the deadline, estate and tax planning for the year ahead. And again, my name is Alan Feller. I'm the owner and managing attorney for the Feller Group PC. I've been doing this type of work, estate planning, elder law, trust and estates, probate, since I was a young law student in the mid 90s. And it's my favorite thing to do in the world. Love it. It's what keeps me going. We'll do some basic housekeeping because that's what lawyers do to stay organized. So let me minimize myself, otherwise my big head will block a lot of the text. So our disclaimer is been set up to say this webinar is for educational purposes only. It's not legal advice. Uh, what that means is that if you say, well, Alan said on the webinar that I can take all my money and move it to Guatemala and give it to my friend Tony. No, that is not legal advice. It's purely educational. Laws vary by state and individual circumstances. So just be aware of that. That's a big part of what we do here. We're giving you education, things that you could take advantage of. So just to set out today's agenda so it's clear, so as you're organizing your own thoughts and writing things down, hopefully you have the workbook that we've given to you and you've downloaded it. It's a way to work off of what we're talking about, scratch your own details, and actually make something tangible for yourself. So as far as our agenda, we want a clearer view of your current plan. So whatever you have in place now, whether it's nothing or a fully featured estate plan with trusts and wills and powers of attorney, we just want you to have a clearer view of what you have. We also want to give you insight into potential risks and gaps because all of us, myself included, there are things in your life that you may not have full command of. So this is an opportunity to start to close some of those gaps. We're also going to give you strategies to reduce unnecessary taxes, especially in the estate side. We want to make sure that you're aware of it. Again, not everyone is going to have a taxable estate, but if you do, good to be aware of what the pitfalls are. The thing that will benefit most people here today will be ways to better protect your assets. Because you accumulate, you work, you spend decades going to your job, getting to your car, commuting back and forth. The goal is to preserve it as best we can for yourselves, for your family. This should be something that's useful because it's easy to spend money, it's harder to keep it. We also want to have a plan moving forward with confidence. The plan that you set up, whether it's now or later, it should be something that really makes a difference in your life. So we're going to get into the crux of this conversation is, again, why estate planning matters after tax season. Well, because for all of us, that's the time and the opportunity when you're putting together all of your finances, you're getting your W-2s, you're getting your 1099s, you're having all your stuff and you put it on your desk and you organize it and you start to see a pattern. You start to see what assets you have, what income is being earned from assets, jobs, investments, whatever you have, it starts to give you a picture. And then you look at your expenses and you start to get a sense of what's involved with doing proper planning. So again, after tax season, after April 15th, so literally in the moments from this moment forward, you want a clearer picture of your finances. You also get updated information about your income investments. You're thinking about it in the moment, in the present. It's not something that's amorphous in the future. Planning is partly being aware and then also executing. So of course, April 15th is also a greater awareness of tax obligations. Hopefully you're working with a skilled accountant, CPA, a person who does this type of work every day. Now, obviously, if you're an employee, you have very little resources, income, and maybe you do it yourself. Again, a lot of people do it themselves. I don't poo-poo that. I always like to say it's good to have a professional working with you, because no matter how skilled and intelligent you are in your chosen field, there's going to be issues if you're going outside of it. If I decide to put on an addition to my house, I'm going to be scared for my wife and daughter, because that may crumble on their heads. So that's just me. But other people may have an amazing skill to put up houses and drywall. I will never, ever poo-poo that. So again, what's the cost of waiting? What's the cost of postponing things and pushing? Again, procrastinators, rampant in the legal field, medical field, people who do amazing things for others and help other people every day, but for themselves, yeah, there's a procrastination factor. If you delay doing your planning, you're going to get family disputes, court involvement, higher taxes. Assets will be distributed in ways that you didn't really want to. And then, of course, planning ahead helps prevent, unnecessary issues. So this is a major part of planning, is just do it. Get it done. Work with a professional. Work with people who really know what they're doing and have a long and proven track record. This is not something to experiment with. You want to have people that do this every single day, 20 times a day. So now you have your workbook hopefully in front of you or online. You're looking at everything. So this is our first check-in. When was the last time you reviewed your estate plan? Was it today, this morning, when you took everything out? Was it last week, last month? Write that down, because that number may give you satisfaction and assurance, or it may scare the hell out of you. Have your finances changed since last year? Have there been big expenditures, large gifts to family members, paying college tuition, paying a new car, whatever it is? Have your finances changed in the last year? Do you know whether your current plan still reflects your wishes? You were planning on giving Cousin Robbie $4 million. Cousin Robbie, of course, has moved out of the country, hasn't spoken to you in 5 years. Probably not the best idea to keep that old estate plan. Of course, I'm using extremes. I repeat this over and over, but this happens. People do an estate plan in 1998. Their kids were 5. Things may be completely different. Would your family know what to do if something unexpected happened? Do you have contingency plan? Does your family know where your estate planning documents are? Do you have an estate planning document to give them? What would your family do in that case? So that's a good question to ask. So again, how do you understand your financial picture? I want everyone to be aware of this. This is very important. This is probably the most important part, because before we go into planning and estate protection, asset protection, first understand what your financial picture looks like. That's why we're here. That's why you just pay taxes, to maintain your financial stability. So the first thing you do is you take inventory of your assets. Again, my favorite subsection of this little presentation here. So your estate may include personal property. It can include, again, personal property means your collectibles, clothing, vehicles, basically anything that's belonging to you that's not a financial account or a piece of real estate or a business. Personal property, again, a lot of value can be found in some of your personal property. If you're collectors, if you have hobbies and interests, what you own, what you have in your personal property may be very valued by people outside of your house. Maybe in your house, they think you're a hoarder and they'll be very upset at you, but the rest of the world may find value. You have vintage clothing, you have things of value. Be aware of it, keep track of it. If it's something, especially collectibles, take notes, get the valuation. Because here's a very important thing. Your family, your children may have no idea what your personal property is worth, especially if you have an interest in it. You may have a massive LP and record collection going back 20, 30, 40 years. Maybe it's a good idea to keep a value of it, organize it, let your kids and family know what to do. Real estate. Now that hopefully will be a little more transparent. If you own your home, if you own a vacation house or a second property, a pied-à-terre in the city, do you have even a timeshare? Again, not my favorite thing in the world, but if you have it, keep track of it. What do you own in the real estate sector? Life insurance. Do you have a whole life or term life? Term life is not an asset. Term life means you pay money. If you die, they give you money, but you don't have cash surrender value. You can't take a loan against it. And there's usually a term it ends, and you can decide what to do. But with a whole life plan, again, if you have a whole life, it's an asset. It has a cash surrender value, which means if you pull it out, you'll get money for it. Sometimes pretty close to the face value, sometimes not. You can take loans off of it. And especially if you ever get sick and there's a Medicaid issue, people forget that life insurance policy is an asset that has to be dealt with. Understand what type of policy and how much it is. Retirement accounts. Do you have qualified retirement accounts? Now, this could include IRAs, 401ks, 403bs if you work for New York City, New York State, you're a nurse, you're a teacher, fire, police. Know what type of retirement accounts you have. Do you have a TDA, a tax deferred annuity? Look at what you have, understand it, and be able to communicate to the people that are going to deal with it. Do you have beneficiaries on those accounts? Very important. This is part of your inventory. Know what you have. Investment accounts, this could be, you may have something with Charles Schwab, Merrill Lynch, you may have Chase Private Banking, you may have any type of institution that is investing your account. You may have it, with a TD bank, you may have anything you could think of, whatever has an investment arm that's earning interest or taxes or anything with stocks and a portfolio. I want you to really dig into every part of that. I mean, and you'll know when you get your 1099 for tax day for April 15th, which is today, you'll see what your investments are earning. That's why I mentioned taxes, because usually that's your best clue. What do you have in the investment side? Business interests. Do you own a business? Do you have a law firm, a medical practice? Do you own a plumbing company? What is your business interest? If you have it, make sure you understand what type of entity it is and how it would pass in case something happened. So here's a real life example. So a family walks in, they greet my intake specialist. I may be called in to talk to these people. A family has several investment accounts. They have retirement accounts, and they have real estate properties. However, the accounts have different beneficiaries and ownership structures. Without coordination, this mishmash of situations can lead to, number one, assets bypassing the estate plan. So if you have a retirement account that has a beneficiary listed, let's say you have a sibling on as your beneficiary and not your new spouse or not your kids, and things happen like that, yeah, you may put the burden on them to try to seek ownership as a spouse. And there's different ways to do that. But if you don't have that coordinated, you're creating a problem. Same thing with unequal distributions. Let's say some things are going through beneficiaries and others going through a will and trust. So because of the way you set up, let's say your investment account, you give 80% to your son, Phil, and 20% to your daughter, Barbara. But then in the will, you have 50-50. But meanwhile, the net result of that is that your son's going to get way more than your daughter. And they're going to be very upset. And they may not be able to get at you beyond the grave, but they're going to be very angry kids. Don't do that. You want everything to be properly set up so everybody's happy, the family dynamics remain the same, and you don't have a 20, 30-year blood feud between your kids. And this happens every day, all the time. And people take it lightly, but it affects families, kids, grandkids, relationships. Very important is issue number 2. As far as unexpected tax consequences, different assets are taxed differently. So especially when you deal with a piece of property that you bought in 1973, you took a drive up from Upper Manhattan. You said, hey, we want to get out of the city. The city's crazy. Things are falling apart. Let's find a nice bucolic country setting. You buy a house. You spend, I don't know, $25,000. The house now has accelerated in value, grown tremendously. Now it's worth $850,000. If you gift that asset to a child without proper planning and the kid sells it, they may take your original basis and then have a capital gains hit of massive proportions. And again, it's even with a good account and good professionals trying to mitigate it, big problems. That's why all these things, talk about a real life example, this stuff happens every single day. I really want you to think about this. So we're going to downshift a little bit now after you've heard all of my rantings and ravings about proper planning and coordination. You look at your workbook and you say, okay, number 1, in this case, 5, do you have a clear list of your assets? Can you write down off the top of your head, just from what you've been seeing and working with your tax preparer and different assets and income earned, what is a clear list of your assets? And are your beneficiaries up to date? Do you know off the top of your head if your beneficiary designations are up to date? Or do you have to seek it out, whether online or contact your investment company? Who are your beneficiaries? Have you reviewed how your accounts are titled? Because again, titling is so important. If your property is titled you and your spouse, the survivor will inherit. If it's with you and a sibling, it may be a tenancy in common, going through 2 separate estates. How it's titled is very important. And again, so important. Would your family know how to locate your financial records? Is there a conversation that's needed to get everything situated, not just in your home, but also with your family knowing what to do? So this is the time of the webinar. We always dig into, hey, what are your core estate planning documents? What do you need to have the basics done so you're avoiding big troubles or issues in the future? So what's our foundation of an estate plan? I mean, I love these titles. We put this in to make it sound serious and important, because it is. Again, we don't take ourselves seriously, but we take our work seriously. The foundation of an estate plan, and again, most include these essential documents. Now, the primary and the building block for most estate plans are a last will and testament. This is the thing. If you have nothing else as far as dictating your estate plans, a will is a catch-all. It basically will pull any assets under your name with no beneficiaries, no joint account holders, and allow it to pass to the people you want to give it to. If you have minor children, it'll set up guardianships in case something happens to you and a spouse or a partner. Very important to have that. The last will and testament is a great device if you have nothing else. Of course, as an estate planner, we're always going to tell people to have some form of trust set up eventually, whether it's revocable or irrevocable. And again, we'll talk about what a revocable trust is. Again, if you have means, you have assets, you're not concerned about long-term care and protecting assets on that level, then a revocable trust takes assets, puts it all under one umbrella. So a revocable trust is under your name, under your social security number. It allows you to put your property in, house, assets, non-retirement. You don't want to put qualified retirement accounts. Those are federally protected accounts. You want to put revocable trust assets, including house, investments, certain bank account savings, not checking your normal. You can open up a trust checking account, but you really don't want your social security go in necessarily. But you want to have flexibility so that this trust can capture all your assets that have titles on them, put it all in one place. It avoids what's called ancillary probate. So let's say you have a piece of property in New York, that's your primary residence. You have a small place in Florida or a condo. That gets all put into your one revocable trust. It avoids an ancillary probate in Florida and a regular estate in New York, saving lots of money, lots of legal fees, lots of stress. So easy, and it passes to your loved ones without any court interaction by operational law. We really like trusts in all forms. Power of attorney, everybody should have that. Everybody in America should have a power of attorney once you're over 18, because what that does is, God forbid something happens to you. You have a health crisis, an emergency. You can't pay your bills. You can't handle your affairs. Having someone appointed to be able to make decisions, to pay your bills, gather your assets, protect your assets in emergency. Power of attorney allows you to do that. Now, you can have them have a power immediately. There's also language called springing power of attorney that can make sure that you are in a disabled state before power is granted to someone else. There's options there, but very important. And then there's healthcare proxies or medical directives. If you have a healthcare proxy, you're making someone basically your decider for healthcare procedures if you're unable to articulate or advocate for yourself, as well as possible discharges and so many other things. It's so important to have a medical record that someone can put in your chart and they know who to talk to when something arises. You don't want ambiguity. You don't want people searching for who's going to make decisions if you need a decision about a procedure. It has to be done. This is not something that's voluntary. In fact, most hospitals give it to you when you go in. So again, what happens without these documents? This comes to a real head when you have a situation, you don't have a power of attorney, you don't have a healthcare proxy and things start to go wrong, healthcare crisis, emergencies. So without a designated agent with power of attorney, then we're talking about Article 81 guardianship in New York. We're talking about spending 10, 12, 14, 16, $18,000 for this very long, very complicated proceeding in court. Article 81 guardianships are not cheap. They're annoying. We deal with this, you know, very infrequently because I don't like to deal with them. That's why we have our clients have their advance directives. But if people don't, the Article 81s are available for that purpose. And we really don't like them. But if you don't get your documents done, then you have to go through a very lengthy and very expensive court proceeding. Who makes medical decisions? Same thing. There is a statute that does allow a closest relative to you, spouse, child, to make decisions in the absence of a healthcare proxy. But if that person is not someone you wanted to have, the law under the state of New York is basically dictating that. So that is something to be aware of. That's why you put it down in writing. Have the people you want doing the things you want. You don't want a court or you don't want New York State deciding who makes decisions. And as far as how your assets are distributed, if you don't have a will or a trust or proper beneficiary forms, New York has what's called an intestacy statute. Under the laws of New York, they're going to give your assets to who they feel under the law is deserving of it. Basically, we're talking about if you're married, it'll go partly to your spouse, partly to your children. It may, again, no spouse, no children. It may go to a sibling. Someone you haven't talked to in 30 years may get your assets. Have an estate plan properly set up. So when you look at your worksheet, do you have currently a will or a trust? And again, have you appointed someone to manage your finances if needed? Have you gone through those steps? And many of you, of course, hopefully have a healthcare proxy. Do you know who that person is who makes medical decisions for you? Should you be unable to? And again, remember the last time your documents were updated. They updated the last 5 years, 10 years. This is very important too. Hopefully, this is not something from 1995 with all people who are deceased. Make sure you check. The estate tax and wealth transfer planning portion of this is something that, again, if you have the resources, you've built up quite a decent collection of assets and resources, you should be aware of how the tax authorities look at this, what type of planning should be done. And this is something that I want you to really focus on if you have those resources. And if you don't, it's still a good idea to be aware of. You never know. You may have an inheritance down the line. You may have some other things coming to a head at some point. Good to know how this works. So some of the basic planning strategies to reduce unnecessary tax exposure. You have some combination of lifetime gifting, trust structures, coordinating tax and estate planning strategies, and strategic asset transfers. And we could talk about all these different components, including lifetime gifting and what that means, and then trust structures. So these are the building blocks of a proper tax reduction. So here's your real life planning scenario. A family accumulates significant wealth over time, but does not implement any tax planning strategies. When assets are transferred, heirs may face unnecessary taxes. With proper planning, families can reduce these burdens and protect more of their legacy. So let's dive into this. Let's get into the numbers for 2026, because that's partly why you're here too, especially if you're focused on it. For example, New York State has upped their estate tax exemption to $7,350,000. And what that means is that if you have accumulated an estate valuation of just under $7.35 million, you won't pay any New York estate taxes. If, for example, you are just at the minimum, let's say you're at $7,350,001, you'll pay a small amount because you've exceeded it. It's not going to just be on that $1 or $2. Because New York State does allow you a little bit of leeway up to about $7 million, $717,500. So the difference between 7.35 and 7.71, that difference, if you have that amount exactly, then Basically, you only will pay the difference between those two figures, and it's a very small estate tax burden. And if you have under it, you won't pay anything. If you have over the 7.7 million, then you're going to pay actually tax on the entire amount. So if you have 2.2 million, you're going to pay New York State estate tax on that entire amount. That's why good planning makes so much sense. The other thing we like to focus on is you are entitled to an annual tax exclusion from the IRS, the annual gift exclusion of $19,000, basically for any individual anywhere. So if you have a large family, you can give everybody 19,000, and if you have married couple, you can give 38,000 as a combination to one person. Now, of course, for tax purposes, it's fantastic. You can start to develop basically reducing your overall estate by just using these gifts every single year to your family. So if you have a large estate and you start to, it adds up 19,000, 38,000, 19, and you keep putting in year after year after year after year, it can reduce your estate tax burden. Of course, if you're an in-between level and you get sick and you may need Medicaid in the future or your assets have declined, then all these gifts do become transfer penalties for Medicaid and nursing. Be aware of it. It's not part of this discussion, but it's something to be aware of if your numbers are skewing lower to that. Quick aside also, if you have a spouse who is not a U.S. citizen, you can gift them without creating any filings for estate tax or gift tax up to $194,000 as of 2026. But to be aware of if your spouse is not a U.S. citizen. So just to be aware, and also just as an addendum to what we talked about, the IRS totals for 2026 is $15 million, $30 million for a couple. So if you have over $15 million, you will be paying the United States estate tax to the IRS. So that's the total. So the two big totals you have to keep in mind is for New York State, 7.35 million for the Internal Revenue Service and the U.S. government, it's going to be $15 million. Be aware of it. So once you're familiar with those thresholds, and I hope you have your workbook, you can write that down in your workbook. Have you explored strategies to reduce your estate tax? I hope you have. As far as coordinating estate planning and tax planning, use a professional, use a law firm, CPAs, professionals, estate planners to get your numbers in order. And again, would preserving more wealth for your family be a priority? I think for many people who have built up that money over decades and generations, preserving it for the family, for the good of the family, for college expenses, for their family's overall financial health, this is so important. So protecting your family and your legacy, this is what we're doing. The estate tax and planning with estate documents, looking at your assets, looking how to protect it with beneficiaries and estate planning. It's all part of the same thing. What's your legacy going to be to your family? Are they going to be remembering you for the generosity and for the support and the security you've given them? Or are they going to remember you for an absolute train wreck disaster that you left because you didn't do your planning? And of course, the net result of all this non-planning is a family that doesn't get along, that's getting upset over money, over inequality, and basically a mess that was left in the hands of one or two kids, maybe, and while others are not helping out. This stuff happens every day. Get your plan in order. It's very basic stuff. And I've written articles about this for forever. It's, when you talk about estate planning, what is it? It's about people. It's about people and preservation. So when you plan your year ahead, you say, okay, well, passing April 15th, I know another year before I have to pay taxes again in this way. Besides, if you have to estimate it. What are you doing? What are you thinking about? You're thinking about your planning. You're thinking about passing down your assets, especially at a certain age. You want your kids, your family, your loved ones, the people closest to you, you want them to get the best of you, the best of what you built, so that their lives are better than yours. That's the goal. The goal is to make each generation better off than the way you've been. So you're protecting the people that matter and all the stuff that you've built. And again, without proper planning, you have major issues. Proper planning is important. So part of the planning also is how do you ensure financial stability for a spouse while minimizing tax exposure? The ability to transfer funds back and forth with a spouse under U.S. law is fantastic. Take advantage of it. Structuring assets to protect beneficiaries from unnecessary tax burdens. That's why we set up trusts. That's why we set up trusts with special marital protections and marital tax planning. There's so many ways to do it. You can also plan for children dependence with both care and financial efficiency. One thing people don't know is that if you make direct payments for your child's tuition or direct payments for medical expenses, again, these are not part of your, basically your estate tax threshold or your gift tax threshold. These are exempt payments for a specific purpose because they're going directly to tuition, directly for medical expenses. Keep that in mind. That's a big part of what we're doing. And again, as far as charitable goals with potential tax advantages, as you get into that higher level of planning and you work with a skilled estate planner, they're going to be able to give you, I call it it's like the alphabet city of tax planning with charities at the center of it. NIMCRUTs, and there's so many funny names. I could go all day on this. I've taken a billion CLEs sitting there. When I was a young lawyer, you started hearing all these nomenclature. I mean, my head was spinning. But the beauty of getting old, you realize there's a lot of value when utilizing charitable giving with estate planning. The ability to have money get to a charity and then the remainder goes to family or vice versa. So you can use charitable giving as a way to preserve your estate and avoid taxes. And of course, the charities love it because they're getting a windfall. So it's a win-win for that. And plus, if you go to the right charities, you're making a difference. There's so many cool things we can do to make the world a better place and help your family. This is the time where I usually take a little sip of tea. It used to be coffee, but when you start drinking coffee over and over and over again, you get hungrier and hungrier and hungrier. Tea is a little bit better. So I'm just going to take a little sip. When we look at financial and family complications, the two go hand in hand. Because, when you don't do these things right, I mean, that's why I keep saying it, because I see it every day. I see it. It's so close to me. Not just in my life, I've seen it professionally for decades. When things are not handled right, assets aren't being distributed the way it's supposed to be, and you have more taxes to pay. You also don't transfer wealth efficiently. You're doing things through probate instead of through trust or through your beneficiary forms. When you start to do these things, or you create delays that increase administrative costs, you don't get appraisals quickly. Your trustees or your fiduciaries are slow or not the right fit for your estate. And also you don't use the proper professionals. Then all these things start to snowball. You may even put more burdens on family than you ever intended. Then there'll be disagreements. One thing I've done over the decades is I love to have family agreements, which are basically like little mini contracts between a family member and another family member or multiple family members that basically puts all their concerns, all their issues about who got this money, this property was transferred, this issue, this gift was given, and it puts it all in one place, equalizes things, or at least gets it to a point where the family is in agreement and they understand. They may not be happy, but at least everybody knows the situation. Because you don't want disagreements that the heirs and everything hits them so hard, a relationship, a family can fall apart. So when you look at your workbook, you pull it back out and you say, okay, what do we have here? Are your assets, number 17, structured in a way that supports both your family and tax efficiency? Have you set it up? Again, many people will use even irrevocable trusts. If you have significant assets, you have LLCs, other businesses, you own real estate holdings. And if you have proper estate tax planning and proper estate planning that avoids probate, you can definitely have things that your family and your tax burden is limited. Right now, if you look at what you have currently, does your current plan preserve wealth or does it lead to unnecessary costs or taxes? If you don't know, this is a perfect opportunity to contact a legal professional, an accounting professional to see how this is all going to work. Number 19, are there beneficiaries who may require additional planning or protection? We haven't gotten into this yet, but at 134, this is a good time to talk about it. Not every beneficiary is the same. Some people have a life which is really on track. Their career is going like gangbusters. Their personal life is very, solid. You're looking at them as a really successful, very well-grounded person. And then you have beneficiaries or family members who have not hit that point yet. Their careers are stuck in limbo. Their personal life is complicated, and they may have other issues that makes their financial future murky. By having proper planning, again, it's where trust planning comes in, because trust, you can set up safeguards. You can put together spendthrift language that avoids giving someone a lump sum. You give someone who has a severe gambling or substance abuse problem a lump sum, what do you think is going to happen? Nothing good. By having good trust planning, you can set aside money and gift them over a long period of time, almost like a little income stream that allows them to pay their bills, get their expenses, but doesn't take away their resources that they'll need in the future. And again, as far as number 20 goes, have you aligned your estate plan with your broader financial and tax strategy for the year ahead? Does everything work together and flow together well? It's pretty easy. Have a checkup. We always like to give annual checkups for our clients just to see where they are, see how things are working. And if something's not working, we can tweak it. So what does keeping your plan updated mean? Well, I can tell you. Plans should be reviewed as frequently as possible. Now, again, it doesn't have to be 3 times a year. It could be once a year. It could be twice a year. It depends on what's going on. But look at it every year, because things change every year. Family members come and go. You have marriages come and go. You have jobs come and go. Moves. You may move to Florida. You may move to New York. You may have a place in New York and Florida. You may have a variety of things. This is a good time to keep track and make sure things are what you want. So again, what events trigger a review? Hey, I talked about part of them. You may have a change in income or assets. All of a sudden, your job has given you or bestowed upon you a much higher salary. Plus, you may have more responsibilities, or your investments have exploded. So that's one thing you would have to keep in mind and talk about your planning. Tax laws, exemption laws, planning opportunities. Again, the way the government and the way everything is being moving right now, there's so many things that are uncertain. We always are watching, we're seeing where the winds take us. But if there's a tax law change or there's something that affects people's pocketbook, we'll be there to help you. And of course, family changes, as we talked about, marriages, death, divorce, so many things come up, new baby born, all these things change how we do estate planning. As far as relocation to a different state, again, that's why the beauty of the trust that we do, if we do revocable, irrevocable, we always put a situs of trust clause, which means that if you decide to move and your house in New York is in your trust, you can go to other states. Your trust basically travels with you. I always recommend talking to an attorney in that state to see if there's any other documentation that has to be adjusted for local laws and local efficiency. But if you relocate, make sure your planning reflects that. So again, I disagree. This is, I mean, I say 2 to 3 years. I mean, we try to be friendly about it, but I go back and forth. I like to have everyone once a year. 2 to 3 years, when I wrote that down originally, I think that was a more generous approach for people, but I think times are a little different. Things are a little more chaotic. Prices have exploded. Things are more chaotic now than they were maybe 10 years ago or 15 years ago. It's a different world. So I think you want to review more frequently. As far as financial changes, liquidity, or after tax season, these are all opportunities to take a look and see what you have. So one thing I want to make sure is when you do your workbook, again, did something pop up this year when you check your taxes that really stung you? Was there something, did you lose income? Was there losses? Were there gains? Did something give you either an opportunity or a gap to close? And again, is there any strategies that you're aligning with your long-term wealth transfer goals to the next generation that also you want to look at and talk to a professional about? And again, would a professional review help you? I always say yes. It's good to talk to us. We have a whole range of professionals that are always here to help and are encouraging and making sure that you're protected and your family's protected. So for 2026 going forward, again, we're already in April, we'll be in May before you know it. These years move by super fast. They always told me when I was younger that time accelerates. And again, when you're young, you're in first grade, everything is new. Every single thing in your life is the first time you're seeing it. So, of course, first grade seems to last 30 years. By the time you get to be in your 40s, 50s, 60s, 70s, you've seen everything. And everything blends together and moves just through your life super quick. So, again, the strategic plan for the year ahead is here. We're here in 2026. It's already middle of April. I want you to at least think about it. So, what's your action after this day, after April 15th? Again, review your estate plan, go through your financials one more time. See, just remember what things really knocked you out when you talk to your accountant, what things really hit you. As far as gifting strategies for the year, again, if you have the resources, if your planning is looking into a threshold of New York State estate tax or possibly federal estate tax, and you have a lot of investments, a lot of business, you have a lot of things cooking, having a gifting strategy for this year is worthwhile, and including, of course, the $19,000 annual exclusion, plus other gifting strategies. Now, again, trust structures for efficiency and tax purposes. If you don't have a trust already, and you really have your assets floating around under one owner, this business, having a trust really is great, because one of the beauties of a trust, and I'll keep repeating it because, hey, why not? It's a webinar, is if you have an LLC or you're thinking of creating an LLC to hold real estate for either investment purposes or you have rental income, you want to have a VRBO, you want to have an Airbnb, you want to do something, or you have a business. Now, you can make your trust, for example, let's say you have a revocable trust. Your trust can be the member or owner of the LLC. So basically, you have a limited liability protection in case someone sues you or in case there's an issue in the property. But as far as passing it on to the next generation and avoiding court and probate, your trust can take that LLC that owns that property and pass it along. So you have the best of both worlds. You have the limited liability aspect of an LLC and the trust being the owner of the LLC. Pretty cool stuff. So when you align your estate plan with your overall financial strategy, you see how all these things start to fit together. You have your updated beneficiaries that equalize. Your trust planning makes things easier, puts everything under one umbrella. And then, of course, you have good financial planning, good tax planning. These things work, and you don't have to stress. And you don't have to worry. You can look at your financial life and your kids. It's just so much easier. Limit the stress, if possible. Things pop up that make that impossible. And again, one thing I've noticed, again, in my life and people I love in their lives, when you do things under pressure and you do things because, oh my God, my car is broken and now I have to rush and get a car, or I'm dealing with an emergency, now I have to go into action. Everything costs more. Everything is more expensive. Everything is more of a pain when you do things under pressure in emergency. You want to do your Medicaid planning when the person's already in a rehabilitation facility or a hospital, and you're trying to save all the family's money at the last minute emergency. We can do it. We can save a good chunk of it, but you can't save all of it. And there can be a lot of issues in that regard. If you do things proactively, but not under pressure, then you have more flexibility, more opportunities to reduce tax exposure the longer we plan ahead. And as far as avoiding last minute decisions at year end, why rush? Why have additional stress? It's so easy now. I mean, it's like one of the beauties of technology is your ability to grab information, pull information up, get access to stuff is so easy if you take advantage of it, if you have that kind of wherewithal. Whereas years ago, you'd have to go to the bank, you have to call the account, you have to do all these things to gather information. A lot of times you'd be getting old information. It was a real pain. As a kid, my parents would drag me to this bank and this account and this they were teachers. All they wanted to do was have this perfect, wonderful binder full of information, fill it up. But they spend so much time and so much energy doing all this. And now we can do it so much easier, but so many people don't. It's just take advantage of it. Because if you have that time, you save time and money later. So after this tax season, are you planning on taking, or have you taken any steps to update your planning? Are there strategies you intend to implement but have not yet addressed? And again, what I'm telling you is write this stuff down. When you have your workbook, put this down. What type of strategies are you thinking about? Are you ready to act now and not delay things? Are you being proactive? And again, this is important because, again, the stress, I mean, we've lived it. I lived it. You lived it. When you wait and you wait for the emergency, you wait for the stress point, everything becomes harder. And then you live with anxiety. Oh, God, I hope this works out. I'm doing this last minute. I hope this works. And that's how people live their lives. If you can plan ahead, again, not everybody can follow this in the moment. We get it. There are things we put off, but this is not one of those things you should put off. So again, how do you maximize efficiency and you avoid missed opportunities? Again, common planning gaps. Again, I go through this year after year. I want you to really focus on it. If you have an outdated document, look at your trust, look at your will, look at your power of attorney. Is it 20 years old? Is it 15 years old? Look at it. If it's outdated, let's update it. Let's save problems. Are there lack of coordination? Are there missed opportunities for efficient wealth transfer, moving assets from one to the other? Are your beneficiary designations properly set? I keep repeating it because I want you to take a look at your stuff and make sure everything works. Because if it works and it's smooth, and I've had clients for decades, and the calls are always polite and friendly, the conversations are easy because things are moving forward in an efficient and a simple manner. If they're calling with problems and difficulties, yeah, then we haven't done our job. So how do you do it? The best strategies, the best coordinated strategies are always make sure your legal, your financial, and tax strategies are working together. If you already have your team set up, if you have an accountant, lawyer, financial planner, or financial advisor, get them together, get them discussing your estate, your tax planning, your financial estate plan, everything set up. Get your team together. Everybody should have a team. In fact, this is your opportunity to be a general manager of a baseball team or a basketball team. General managers pick and choose their team and hope they can get to a championship. Now, our championship really is the fact that your kids or your family or your loved ones or the people important to you get the best out of the situation, have the easiest time, have the easiest access to what they need to do. And that's your championship. I mean, that's your Stanley Cup. That's your World Cup. That's that champagne moment where they pour it on your head, is you've made things easy for them. You've preserved the family integrity. There's no fighting. When there's a birthday party, there's a 50th birthday party, an anniversary party, everybody shows up, everybody's happy, they're having a great time, there's no fighting. So that's your championship. Regular communication with advisors, talk to your people. We're here. I mean, we're in the office. I mean, I'm here pretty much every single day, as much as possible. People call up. This is the time to talk to everybody. And we're not going to be upset. We like talking to you. And we like to make a difference. We like, if we can do some problem solving, make your life easier, everybody wins. Again, look how everything is titled. I'm going to always say that. Just check your stuff and then adjust your strategies as things change. You have your workbook, all the same things we just discussed. Write it down. Be focused on it. It helps. If we do meet, it's a good way to look and see what you've done and what you anticipate doing. So what are your next steps? Your next steps are make sure you have a professional review what you have. And even if it's been a while, good opportunity. This way, the professionals can do all the things they need to do to get your plan in place. Our process with the Fellow Group PC, we always start with a consult. It's a 30-minute case evaluation meeting. Our intake specialist will review all the parts of your case, your matter, what things you need to have happen, and then they will start you on your way. Once you agree to work up with us and you have a good feeling about continuing on with our professional relationship, you sign a letter of engagement. And then once we have that, we get started. We'll have a design meeting, which usually puts together all the estate planning respects. Our team is great. We have wonderful attorneys, wonderful paralegals and professionals. We're here to help. And I'm always here hovering, bothering people. So this is the beauty of a great team working together. Once your design meeting is set, then the drafting continues and we'll get a document ready, hopefully documents ready to be executed. We'll have a signing date. And then once everything's been reviewed and then executed, your plan is set. And if there's deeds that have to be recorded, we'll take care of that. So if you schedule your free planning consultation and you decide to go forward, you do get a $500 savings over if you have trust planning and really a full-featured estate plan. $500, you can't beat that. That's a great idea. So now we get to the Q&A, questions and answers. So if you have questions and answers, we are here to answer. I'm here to answer on whatever things you want to talk about. We can definitely go into it. So you have a chat or Q&A box next to you, and we can take a look and see what we want to talk about. So let's dig into the questions. I know we have a bunch from different people. We could say, how do I know if I have a taxable estate? Okay, well, that's easy. We did talk about that. So what you would do is you would look at your overall assets. So if you own real estate, if you have investments, obviously investments are easy because that you can just take a look at and you can see the balances in them and see, of course, what that total is. And if you have life insurance, as a cash surrender value, these are all things part of your overall estate value. Now, if you have real estate, you may want to actually have an appraisal done of your properties. So if you have that, that will give you a total. If you're over those thresholds, as we talked about, for the New York State, it's over the 7.35 million. If it's the federal government, 15 million. So that's a good big start. For Robert, let's see, we have his question. Whether the trust as currently drafted could create ongoing New York tax exposure if I relocate. What provisions, if any, allow for changing situs, governing law, or trustee to align with the new state of residence, whether any proactive adjustments would now help preserve flexibility, minimize future tax administrative issues. Now, obviously, if you go from a taxable estate like New York to a non-tax state like Florida, what we always recommend, again, if it's a revocable trust, you can add provisions in to reflect the change to Florida as far as your residency status. So again, we always align with a Florida professional if it's an out-of-state or another state's professional to make sure that our trusts and their trusts have been properly looked at. But with a revocable trust, you can add those changes, and again, you can reflect your change from a taxable state to a non-taxable state, especially for estate tax purposes. Because again, that's the beauty of a revocable trust. If you had another type of planning that didn't have a revocable trust, again, a little more difficult. But revocable trusts are perfect because then you can adjust it, amend the trust to reflect your changes. And we have the built-in size of trust anyway, so you can move. If you move to Florida and you go a Florida resident, then you may be able to not have to worry about estate taxes except for the federal level, which is a whole different level of planning, which will be built into that anyway and can be added into it with amendments. So that's usually how we handle that. Let's see the next question. I do not have a taxable estate yet. However, it may happen in the future. How should I plan? Oh, that's easy. Okay. So the key thing to remember is, again, if you anticipate in the future having a potentially taxable estate, again, if you do, even if you're just starting with a will or we end up doing a trust, we would still put in language, especially if you may be in the ballpark. We can put estate tax language or estate tax protections into the trust. And now, even if it's not engaged, if you're not ready for it, but it may be possible in the future because this is planning. We can put, if you're married and you want to put some special marital estate tax protections in, whether, again, there's bypass trust, there's so many cool things we could just put in and just have it there. And if it's not necessary, it's not necessary. But at least we could have that put in just in case. Let's see with the next Q&A. Let's take a look. Wow, okay, this one's cool. I own LLCs, S Corp, and sole proprietorships. How do I put all of that into a trust? Okay, well, I talked about a little bit. So if you have an LLC, you can make the trust a member of the LLC. If you have a corporation and you want to make sure the corporation was an S Corp, C Corp, passes outside of probate, so what you can do is, on your stock certificates, you can do a transfer from individually to your trust. Your trust could be the owner of the shares of stock for that company. I always say we coordinate with a CPA or accountant who's very familiar, who has a good expertise in it. Because again, make sure there's no tax consequences. Again, as a lawyer, we don't like to mix our roles with someone who does this every day. As a lawyer and professional, we know the mechanism to transfer either ownership of a piece of property or a business or an entity into a trust, or have a trust own it so it doesn't go into probate. So that's a big part of that too. But that's really the short answer to that. Okay, the next question, let's see what we got. I already have an existing revocable trust, but I want to think about other estate tax options. Okay. Well, a lot of times people, well, what people do is people actually will have both a revocable trust and an irrevocable trust. So an irrevocable trust, if you put assets into that and the assets stay in the irrevocable trust for over 3 years, it may not be includable in your estate. There are certain rules and guidelines by using this irrevocable. Of course, it's out of your control, and you may not like that, but that's one way you can take assets that are built up and avoid some of the estate tax pitfalls by using a combination of revocable and irrevocable. So again, that's just one way. Our professionals have so many cool things they can do with it. Okay, we're at 1:55, so I'm going to wrap it up. But again, if there's any other questions, this is the time to do it. If not, what we can do is just want to tell everybody thank you. This has been a real treat for me, real pleasure. I'm glad you sat and listened to me. And again, the best I could tell you is, again, the Feller Group PC, what I've been doing for my entire life, basically, entire adult working life, is try to help families and help people get the best out of what they've earned and preserved, and basically keep a family strong and together. Because if you have a strong family, you can accomplish anything, and I've seen it. So, our main phone number, 845-621-8640. We have offices in Mahopac, office in Katona. We have a great set of professionals that are here to help. And hopefully, again, you utilize us. We're here for you. And I want to thank everybody who participated and who joined me this afternoon. It's been wonderful. And I want to thank everybody for participating. I look forward to our next webinar coming up in May. Thanks a lot. My name is Alan Feller, and it's been a treat.